Integrated Wealth Strategies classroom presentation on an introduction to the unrelated business income tax. Hi, I'm Eric Wikstrom, founder of Integrated Wealth Strategies. Thanks for joining me. The purpose of this presentation is to give you a brief introduction to what the unrelated business income tax is and how IRAs are affected by this little-known and misunderstood tax. You see, many so-called experts like CPAs, attorneys, and financial planners will tell you to keep your retirement plan far away from any type of investment that generates the unrelated business income tax. The problem is most of these folks haven't run the numbers, nor do they know how the tax works. And in addition, they just feel that paying any kind of tax out of a retirement account seems so odd, they'll tell you to avoid that investment in general. But I'm here today to tell you, don't let good investments get away from you just because you may pay a small amount of tax out of your IRA, known as the unrelated business income tax. You actually don't lose tax benefits with the UBIT calculation, and the unrelated business income tax isn't difficult at all to understand. So you may be asking yourself, own real estate in my own retirement plan? Why would I ever do that? Well, frankly, your retirement funds may be your best source of investment capital. And second of all, you may not be able to fully utilize all the tax benefits from a taxable real estate investment. What do I mean by that? Well, you see, rental real estate and the operations that rental real estate generates are generally classified as passive activities. And passive losses, if your rental activity generates a loss, are limited to the extent of other passive income. So if you have one rental real estate property and it generates a loss, you're probably not going to be able to use that loss to offset wage income, interest income, or dividend income. So these losses are probably just piling up, and you'll be able to utilize them at some point in the future if you have passive income or once you sell that particular activity. So the key, if you're going to make any investment with your taxable dollars, is to understand the character of the income from that investment. So what's the case for real estate ownership within an IRA? Well, if you make a real estate purchase in an IRA, the income generated from that investment generally isn't taxed in the IRA environment. But if you own real estate outside an IRA, that operational activity is taxed at ordinary income tax rates, not capital gain rates. So again, you could be paying tax of 35 and even up to the mid-40s for the operational income on a year-to-year basis. There's virtually no tax compliance work for IRA investments, so hopefully this will result in lower tax return costs. If you own real estate in an IRA and you sell the property, there's no 1031 exchange issues because you don't have to run out there and find a replacement property within a certain time period. And again, your IRA could be the best long-term source of available capital to buy real estate. Now this UBIT, is it really that bad? Well, a lot of practitioners think it is, but again, I just don't think they understand it very well. So I'm here today to tell you it's not that big a deal. So first of all, there's two main sources of unrelated business income tax in the IRA world. The first is a trade or business environment. So if my IRA is the owner of a fast food franchise, a coffee shop, a bed and breakfast, I need to realize that I'll be paying tax on those operating earnings just like my competitor does across the street. But what we're mostly concerned about is an IRA making an investment in real estate where I go off and get debt financing against that real estate. The unrelated business income tax has a few math calculations. Let's look at one part of it. But here I just want to show you that in any calculation, whether this is for UBIT purposes or if this is for property owned outside an IRA, that's going to go on my Schedule E and then onto my 1040, I basically have rental income minus a bunch of deductions equaling my net rental income. So in this case, let's assume I have these numbers lined up here, and my net rental income is $10,000. Well, the net rental income is the same for unrelated business income tax purposes as it is for regular tax purposes. So now let's take this calculation one step further and look at the unrelated business income tax calculation, compare that to the regular tax calculation. And let's start with the example we just looked at. So if I have a piece of rental property and it generated $10,000 of net rental income, and let's assume that property was leveraged 50%. So it cost maybe $200,000. I used $100,000 out of my own pocket and borrowed $100,000, so my loan to value right off the bat was 50%. On that $10,000 of net rental income in an IRA, I would pay unrelated business income tax of around $800. But if that $10,000 obviously would make its way to my 1040, I would pay tax on that at whatever my marginal rate is, 28%, maybe 33, maybe 35. What happens if my income is substantially more? What happens if I have a small commercial property that generates $100,000 of income? Let's assume I'm still 50% loan to value leveraged. My unrelated business income tax on an IRA would be over $16,000, but that $100,000 would make its way onto my 1040, and it would be taxed at whatever marginal rate I happen to be in that year. Again, I'm using 28% to be conservative, but probably I'd be at a 33 or 35% ratio, so the difference would be even greater. So like this guy scratching his head, the first time I saw this, I said, well, geez, I'd much rather pay $800 to $2,800 or more, and I'd much rather pay $16,000 out of my IRA than $28,000 or more. So the question I have is, what's all the fuss about? So what conclusions can we draw from paying some unrelated business income tax out of our IRA? Well, the easy one is paying some tax from an IRA usually results in less tax than you'd pay if you had the same amount of income that you had to put on your 1040. And this is due to the calculation of the UBIT itself with this little issue called the haircut. I'm only taxed on the amount of income that results from leverage. Now, if you decide, geez, I still don't want to make a real estate investment in my IRA, I think there's some other benefits outside the IRA. I want to own real estate with my taxable dollars. I'll tell you, watch out for the collateral damage that rental income can do on your 1040, because there's a lot of deductions that are based on AGI, like the standard deduction, itemized deduction, student loan interest deduction, tuition and fee deduction. These deductions are all based on an AGI phase out. So the higher your adjusted gross income is, and if you throw rental income on your 1040, you'll have higher adjusted gross income. These types of deductions will get phased out and you'll lose the benefit of those types of deductions on your 1040. And in closing, don't let good investments pass you by just because your IRA may pay some unrelated business income tax. I hope you've enjoyed this introduction to the unrelated business income tax. You can find us on the web at iwealthstrategies.com. Thanks for listening. I'm Eric Wikstrom, and until next time, here's to a better way of investing.